Hi, my name is Bev Lewis, and I am the owner and president of Positive Solutions Divorce Services. And today I'd like to welcome my guest, Matthew Krofchick. I think I said that properly.
Yeah,
there you go. Matthew is a business valuator, and I have asked him to be a part of my video series for educational videos for people that are going through a separation and divorce. Welcome, Matthew. I'm
Thanks for
very
having
happy
me.
that you could join us today. There's a lot of questions around the need for a business valuation when people are going through separation, and I certainly have a lot of clients that ask questions about that. So we're going to have a conversation about that today.
Sure.
So one of the number one questions that I have with respect to clients that are going through separation, when I'm explaining to them the importance of full financial disclosure to divide up their property, divide up their assets, their liabilities, pensions, one of the biggest questions that I get is, do I have to have a pension value? My business valued by an actual, professional valuator.
Right.
Is there enough assets? Is there enough equity in my business to warrant paying for this big expense? For the most part, I think I can answer them, but certainly I do have some questions myself, especially when it comes to people that have they're self-employed, but they don't have a big company.
Right.
So they have, they're kind of the one-man show, right? So they'll say, well, my company isn't worth anything because I am the company.
Right.
So for example, a plumber, you got one guy and maybe he has one employee to help him out part-time or whatever, couple hours here and there. But in a situation like that, is there a need to have a business valuation?
The answer is yes, a business should be valued. So every business that exists has assets and liabilities. And even if there's not transferable goodwill, which we would say is what would allow you to sell it, someone would want to buy it from you as opposed to just buying your assets. But if we just assume for a second there's a business that all that remains is their assets and liabilities, what we would do is we would look at the fair market value of those assets as opposed to the book value of the assets. So when you take a look at a balance sheet, what you're looking at is the book value of the assets. That's what they were purchased for. The fair market value is what someone would buy it for. And while certain businesses, this might be very, very simple. It might be, there's only cash in the business. Well, cash is cash. Someone is only going to pay $1 for $1, right? Mm-hmm. But what if there's real estate on the books? So you might have bought it 25 years ago for $100,000, and now it's worth $500,000. So there could be an underlying asset in the business that you would need to value, and then it's not just the assets, but what are the liabilities associated with it? Is there a mortgage on that property? Do you have debt to a bank or another financial institution or an individual even? So at the end of the day, it's not so simple as just saying, well, my business is worth nothing. Because if we went with that, then no one would ever get their business valued, and we would be in a situation where it would be very unfair to both parties. So the answer is always best to have a professional look at it. Whether they determine that it needs to be done, they can't do without having a conversation with the individual and looking at the financial statements.
So when you refer to assets in a business, are you talking about vehicles and computers and the paper that they buy, or what type of assets are you referring to?
I'm talking about everything. I'm talking about the chair that I could be sitting on, to the computers, to the equipment. I mean, if we're talking about manufacturing, for example, we're talking about the equipment that they use to make other goods. If we're talking about a car rental place, then we're going to talk about lots of vehicles on the road and maybe their computer system and infrastructure. There's also intangible assets, which aren't on the balance sheet. So those could be customer lists, your reputation, but then we're getting into the goodwill potentially, and that becomes a little bit more complicated. But if we're just looking at a straight company where we would say this is an asset-based valuation, And the reason I keep going back to that is because there are certain businesses, such as a holding company, where you would value it that way, because really one of the underlying assets is usually something like real estate. And so real estate, there's ways to value real estate, but you can't just value the real estate. You have to look what else is in that corporation. So what are the debts associated with it? You know, for other companies like restaurants, it could be their kitchen equipment that they have on the books. If it's an IT company, it could be servers and you know, other computer equipment. So the word asset is to encompass any physical item that belongs to the company.
So you mentioned a holding company, so that could be a second company that somebody has. Yeah,
so what we often see nowadays is that you might have an operating company, so a company that does the day-to-day business. A dentist, for example. They may have a practice where they have other people employed, or they might be self-employed, where it's just them by themselves and maybe an admin person. But they might own the building that they're in. And nowadays, because of the way corporations are structured, you would typically have the real estate owned in a secondary company, which we would call the holding company, that would just own the real estate. This is done for liability purposes and maybe some tax planning purposes, all above board. But when you go to have when you're having a separation, both of those companies need to be valued. So often when I get a call, one of the first questions I ask is, how many companies do you actually own? You know, how many operating companies and how many holding companies are we talking about? And some people don't realize that maybe their accountant has set it up that way, that they've got two companies. So it's always best to look and see what you're signing at the end of the year. Are you signing two different financial statements that are submitted to the government? Do you know your corporate structure? Sometimes you have to reach out to the accountant and find out these things. So it's not so straightforward sometimes. It actually takes a little bit of investigating to figure out what is actually needed to be valued for the net family property statement.
Okay, so talking about the net family property statement, which is a document that shows all of your assets and liabilities, and then there's an equalization payment based on those assets and liabilities.
That's right.
Per person. So husband has his own assets and liabilities, wife has her own assets and liabilities, and at the end of the day, there's usually somebody that has a little bit more in net family property than the other person. So how would a business be presented on a net family property statement?
Sure. So what we would do is we would value the business, and everything that we do would be net of taxes. And taxes is a little bit more of a complicated issue and probably a little bit beyond this video, but the owner of the business would need to put the value that we've determined on their net family property statement as an asset to them personally.
Okay.
Because if they are the shareholder of the business, it means they are the owner of the business. And we often see sometimes where both the husband and the wife are owners of the business, 50-50 or some other variation of that. And you know, then the question becomes, well, why do we need to evaluate if we both own half? The reality becomes that likely in the future, you're not going to continue to own it 50-50, right? One partner is going to buy out the other partner,
right?
Because you're in this situation. Now, if you don't decide to buy out the other partner, sometimes they want to know the value because there might be certain estate planning stuff that needs to be done due to the fact that there is now a separation. So it's always wise to at least contact someone to have a look at the business and give you their thoughts. They're not going to tell you the value, but they may tell you if they think it's worth doing a valuation, what the cost will be, how long it will take, generally speaking.
Okay. So with the asset of the business, you're also putting on the net family property statement the liability portion of the business as well. So it's the asset minus the liability.
Well, the value that we would put would be net of all of the liabilities.
Okay.
So everything that's in the business itself, if we give you a value, and I'm just going to make up a number, we say a business is worth $100,000, that already would be net of, if we're doing an asset-based approach, for example, it would be net of the liabilities already there.
Okay.
The liabilities of the company are not the same thing as the liabilities to an individual. And when I say taxes, that would be a liability, because to get the money out of the business, you have to pay taxes. So that's an individual liability as opposed to a company liability.
Okay. Okay. So I had clients contact me recently, and this was kind of an interesting scenario for me. Husband owns a farm. His income, for purposes of his income tax returns, line 150 was $290,000 per year, but he only claimed $250 in income. So can you kind of
never heard of that before?
A little bit?
Sure. So when you own a business, you have the ability to take out, I'm not going to say an unlimited amount, because obviously you're limited by how much money the company's making, but you've got the possibility of taking out zero income from the business up to as much income as available in a year. So let's say net income. So if a business, and we'll just use this farm example, has net income of $250,000 at the end of the year, the farmer has the ability to leave all of that money in the corporation, or they can take some out as dividends or a management salary, or some other combination, or in the past maybe to a spouse or a child. There's other ways of people pulling money out of the company. So their line 150 income is minimal. So under the federal support guidelines, child support guidelines I should say, there's a formula, and it talks about how we would address that situation. And very basically speaking, what we would say is, the company has $250,000 in net income. Is there any reason why that farmer couldn't take out all of that money? And if there's no reason, then we would attribute all of that money to the farmer, plus other things that could be there, like personal expenses or amounts paid to related parties. So these are all things that we would consider when we're trying to figure out an individual's income for support.
So essentially you're going to gross up the income of that farmer.
Yes, and
come to something a little bit more realistic.
That's right. That's right. And so we have to distinguish here between a business valuation and an income valuation, or an income determination. A business valuation is what we figure out to put assets and liabilities on a net family property statement. An income valuation, or an income determination, is used to figure out support. So in a situation like this, we don't call it grossing up in the same way that you've described, and I'll just distinguish this slightly. When we talk about gross up, we usually talk about grossing up for taxes.
Okay.
So if an individual has their pool paid for by the business, for example, and it costs $5,000 a year to maintain, I don't know if that's a good or bad pool, but that is a personal expense that the business is paying for. And what we would do is we would say, if the individual had to pay that $5,000 out of their own pocket after taking the money out of the corporation, they would have paid tax on it. So we would gross it up to allow for the fact that they didn't pay taxes on that money. And so what we would do is, there's a formula that's used, and equivalently, if you're paying about 45% tax at the highest marginal rate, you're effectively doubling that amount. So instead of $5,000 being attributed to the individual, it's $10,000, $5,000 for the expense, and another $5,000 for taxes. So that's what we would call a gross up. The other way of looking at what you were describing would be more of, we're trying to normalize their income, figure out what they're actually pulling out of the company. So although it's the same thing, gross up is a bit of a technical term for taxes, usually.
Okay.
Yeah.
Awesome. So have you got any real good stories that you could kind of share with us about your business and some of the interesting cases that have come across your desk? Sure.
One of the most interesting ones that we had was actually a tracing assignment. So we're called in sometimes when there is a dispute about how much money each side is taking, and whether someone believes that one of the sides is stealing from them. Now, I'll preface this.
Business?
No, this is within a matrimonial context. It can happen in a business, but this was actually in a matrimonial context. It was a very long marriage, but they were second marriages. And we had to go back and look at over 120 bank accounts it was more than 15 years. And this was to determine if one side had been taking funds and putting it towards their side of the family and hiding it from the other side. So a very, very complex case. And it happened around the financial crisis of 2007, 2008, which made it even more detrimental to the to the couple, because they had frozen some of the accounts, and the accounts were on margin. So when they dropped, it created a serious financial issue. So we've had scenarios like that where it was, you start off by thinking you're looking at maybe 10, 20 bank accounts, and it just ballooned. And some of it was to do with banks merging, and because it's such a long time period, people switch accounts, they switch banks. It was a very, very long and interesting assignment.
Wow. So there's a number of things that you do in your business. It's not just valuing businesses.
No. It's we do pension valuations as well.
Okay.
Now those have changed significantly because of new legislation in the last 10 years that say if you have a pension that's for Ontario, for example, that's based in Ontario, you go straight to the pension administrator and they'll value it for you. So that's something that every client should do who has an Ontario-based pension. I believe it's $600. You fill out one form, you send it in, they'll give it back to you. Pension should always be valued. As I mentioned to you earlier before we were on camera, pension, business, and home are usually the three biggest assets. Right. So you don't need to hire someone like me to do it if you're an Ontario-based one, but it's definitely something that individuals should do. Yeah,
and a lot of the companies, the pension companies now are waiving that $600 fee, so you can actually go and get it done for nothing. But you'd have to check in with your own pension company to make sure. But so the pensions, the business, and the matrimonial home, the matrimonial home, whether you're selling it or not, well, more if you're not selling it, that's an important evaluation as well to have done.
Yeah, and
you want to know how much the home is worth.
Yes, and so we don't do real estate appraisals. We work with people who do them. That is another niche area that's done, but again, something that is definitely worth the investment to have that done, because no one really knows what it's worth, obviously, until it sells. But these people use specific methodology to try to predict that based on the market that they understand it. So it's very important. It's important when you're talking about these large assets. It seems like it's a lot of money up front to spend, but I sometimes say to people, think about it the opposite. If you think your home is worth $1 million and you settle on $1 million, and then you found out 2 days later that it was worth 1.2, you would be very upset that you've just lost $200,000, or half of that, $100,000. So it's worth the small investment of having people do it compared to the size of the asset.
Yes.
Generally speaking.
Yes. Well, I had a client a couple of years ago who, between him and his ex-wife, made an agreement that they wouldn't have her pension valued. And I made the decision very quickly that I would not help them until she had that valued, because I knew it was going to be a lot more than what it was on paper. And so they went kicking and screaming to get the pension valued, and it came back over $400,000 more than what they had expected it to be. So if you don't have that information up front, it's very difficult to make decisions. And then when you do find out that information, the separation agreement isn't worth the paper that it's written on anyways, because there's not full financial disclosure, and that goes along with the business valuation as well. Yeah, and that's what I try explaining to people often, is that, it's not about me doing the work. There's lots of work out there. It's about, at the end of the day, when you find out what this thing is really worth, are you going to be happy with the agreement that you signed, not knowing what it was worth? And whether you're the one
it could be the opposite also true. The opposite could be true as well. You could be the owner of the business and you think your business is worth $1 million and you don't want to have it that high and all this stuff, and you end up getting valued and it's much less. So you might have actually agreed to something at $1 million when in fact you would be paying out more money than you needed to.
Correct.
So it works on both sides.
That's right.
And what we recommend actually, when possible, is a joint retainer. The reason being that it saves time, there's open communication between all parties, and you don't run the risk of having 2 or 3 valuators end up doing the work on the file. Each side might hire one person, you might have a third person come in later, you might have multiple reports. These things can become very, very expensive. So whenever possible, I like to recommend a joint retainer. It doesn't mean that it has to be jointly paid for by both parties. No, it doesn't actually. It just means that you're both jointly retaining the person. So at the end of the day, you're more or less agreeing to the results. Is there always room for additional valuations to be done? Yes, but I find that almost all the joint retainers that we've done, if not all of them, there's been no second valuation needed by another company because it's an open process and they know all the questions that are being asked. And who pays for it is a completely separate issue. We've had ones where one party says, listen, I'm happy to pay for the whole thing, I just want them involved. And we've had others that say, I think we should each pay 50-50. And it can be any combination of that.
So this is kind of like a mediation for business valuation.
Well,
both parties are involved and
exactly.
get the information and make the decisions together.
Yeah, it allows them also to take that piece of paper, that report that we've written, and bring it to someone like yourself and say, we've already dealt with this issue. We agree that this is fair. And so now all you're doing is helping them put that into the separation agreement or the net family property statement or whatever document they need it for. So it's something that is starting to be used more. I try to encourage it as much as possible. But I don't think enough words could be put towards how important it can be to ask that question of, does a joint retainer work in this situation?
Right.
And it doesn't work for everyone. 100% it does not work for everyone. But many cases it could work for.
Sometimes I'll have a client that will say, I have an accountant and I'm going to get them to value my business. Right. So can you talk a little bit about that? What's the difference between an accountant valuing the business and yourself? Sure.
So I'm a chartered business valuator, which means that I've taken courses specifically. I have a designation that's specific in just valuing businesses. Most accountants don't have these expertise. They do more audit work or preparing financials or something else, and they don't specialize in this. And while the accountant may have the ability to do it, I'm also an accountant, not every accountant has these abilities. But besides that issue, which they may or may not have the skills, because let's assume that they do have the skills and they understand the methodologies that we would employ. The bigger issue is the perception of independence. So when you hire someone like me, I am a neutral party. I have no money in the game. I have no personal relationships. You're hiring me as a third party, outside person to come and say this is what the value is. And by doing that, you know that I don't have a relationship with the husband or the wife that would influence my thing. Now the problem when a lot of people say I want to use my accountant, the biggest problem is the word my. Because if this person is preparing your financial statements and does tax work for you and does your estate planning, there's a question of independence. And it could be a perceived question of independence, but it's there. So it's very hard for the spouse on the other side to accept what's been going on or what the conclusions are, because they might have a vested interest or a perceived vested interest in making their client happy. And so we like to encourage not to do that at all. Don't go to your accountant for that. In fact, we'll speak to your accountant and have them answer questions about things that you may not know about from an accounting point of view. But when you go to your accountant, you're really just opening it up for conflict, because at the end of the day, your spouse may not trust the piece of paper that your accountant has produced. So save yourself the money, and seek someone out with a CBV,
Okay.
Which is a chartered business valuator.
I've had a number of clients that have actually been in conflict because they're using one accountant,
Right.
who either both of them have used in the past, or only one person has used in the past, and that's exactly what they're saying.
Yeah.
Well, he's your accountant, so of course he's gonna skew the numbers in your favor. So
I hear it often, so that's why I always just say, just avoid it. You know, and most of the times the accountants, this isn't their work. They don't want to do it anyways.
Yeah.
You know, they want to do what they specialize in. So it's just better not to even put them in that position in the first place, and just seek out someone who specializes in this.
Okay, awesome. And another question that I have for you: once somebody has their business valued, does that valuation affect the amount of child or spousal support that they may have to pay
Okay.
to their spouse?
Okay, so the answer is yes and no. So let's go with the no first, and I'll explain. There's a theory called double dipping. And the theory of double dipping says that once you equalize an asset, you shouldn't have to use it to pay support on, because effectively you're using the same asset twice. Excuse me. And so if a business is valued using an income approach, which would say how much money is the business generating each year, and we would apply some kind of multiple to that, people often look at that and say, well, yeah, you're double dipping by using that same money for support. But the courts have been quite clear, and there's actually been a new case law within the last year or so that says, in fact, it's very clear that is not double dipping. And the reason is, unlike a pension, which is what this really all started with, where a pension is a depleting asset. So you have a pension that's worth $1 million. Every time you take out money from that pension, it becomes less. All of a sudden it's 900 and whatever, and so on and so forth, till it becomes zero, right? Whereas a business doesn't do that. A business continues to operate and can grow, it can shrink, but it continue to grow. So you can take out the money that you've taken annually, and it may not affect the value of the business. So it is not double dipping. Now, the reason why the answer is also yes, but in a very different way, is that sometimes what we'll see is when there's large net family property, and let's say that one spouse is being given $1 million, as just an example, a large amount of money, and that spouse does not work. So let's say spouse A makes $250,000 a year, and spouse B makes nothing. Well, they would say that if the spouse is being given $1 million and the spouse can get 5% return, that they're going to get $50,000 a year in interest income. So that interest income would actually be considered income to that person. Now, it's not exactly the same thing, but that's probably the only time, besides pension stuff, where equalizing an asset would affect spousal support or child support.
Okay.
Yeah.
Okay, so another really good reason to get your business valued.
Yeah,
Calculations.
it's important, right? Because, and we've seen this happen actually quite a few times, where people may also have inheritance that they've received,
Yes.
a large inheritance, and they may not work. So the question is, what kind of investment income are they getting off of that that should be used for calculating support payments?
Their income.
Yeah. And although that might not appear on the net family property statement as an equalizable asset, it's still there. It still has to show up on that statement so that those numbers can be computed.
Well, I actually had a client that received a large inheritance when her father passed away, and she was not working at the time, and today I think she's just working part-time, but her husband still needed to pay child support on, because of his income,
Right.
but they took the interest that she would be making from that inheritance into account
Yep.
for her income, not the inheritance part for purposes of equalization,
Right.
but the interest on that inheritance was calculated for purposes of determining child support as her income.
Yeah, it's under the same theory that when you can impute income. So what that means is if someone is underemployed or someone is sitting with $1 million in the bank and it's just sitting in cash, you can say someone should be doing something with that money, or someone who's sitting at home and not working should be working. Mm-hmm. And how much money would they be making? What is their educational level? What is their age? What are their transferable skills? Whatever it is, these questions do come into play. And at the end of the day, the trier of fact, if you end up going to court, would make that decision in a mediation or some other collaborative process or some other process. That might be a discussion that is had where they might say, yes, but if you were to return to work, this is how much money you would be making. Yeah. So it's not just so easy for people to say, well, you know what, I'm just going to quit and not work, and therefore my income will be nothing. It does not work like that.
Yes.
That's been factored into the conversation already. Mm-hmm. Yeah. And
that is called imputing income. And I actually had an old colleague that quit his job when he found out that he had to pay child and spousal support. And the judge didn't like that very much.
No, they definitely don't like that.
That's fine. You want to quit your job or stay unemployed, we're going to take your pension.
Right. So the court is especially for child support. I mean, it's the same for spousal support, but the rules for child support would indicate that if you're holding back, they don't allow it. You've got to make it up some way. So. Yeah, anyone who thinks that is going to solve the problem, it does not. In fact, it'll make your situation worse because now you're going to be told you have to pay this much money and you don't have the money. So you have to come up with the money.
That's right.
And so I would highly ill-advise that.
Go and beg for your job back.
Exactly,
yeah.
Exactly. Something you mentioned earlier was about disclosure. Mm-hmm. And I think it's really, really important that everyone understand that in Ontario, there is the rule of full disclosure.
Yes.
So you cannot pick and choose what documents. The other side is entitled to every document, within reason, of course, that is needed to figure out their income or their assets.
Yes.
And there's been cases very recently where the courts have more or less said, if you don't want to play ball, then we are going to throw the book at you type thing. So. It makes my job easier. It also means that my bill will be less at the end of the day if I'm getting proper disclosure, because I'm not fighting to get that disclosure. I'm not having to write letters. I'm not having to do numerous calls and follow up and you know, all these other things that are associated with it. So I always recommend to people, you have to disclose it anyways. You might as well just do it, because you're going to spend a ton in my costs and lawyer costs, fighting everything, yeah. But at the end of the day, in Ontario, the rules are the rules, and the rules say you have to disclose. Okay. So yeah. Always full disclosure is required.
Yeah, and I tell clients, if you're not willing to make full financial disclosure, you know, show the other party what you have, show the mediator what you have, so we can do our job properly. Ultimately, at the end of the day, your separation agreement is not going to be worth the paper that it's written on.
Of course.
Because you don't have that information. You're not making you're not making informed decisions based on that information because you don't have the information.
Exactly.
So if that document ever went to court, the judge is going to just reopen it anyways because you haven't had that opportunity to make that proper decision.
Yeah, and they might actually penalize you for it as well. Mm-hmm. You know, so it's not just you have to do it because they say you do it. It's if you don't do it, the repercussions are that they will say, well, you had the opportunity, you chose not to do it, and here's the list of the penalties you're gonna receive because of it.
Yeah, and especially if you're doing that maliciously.
Yes.
You know, you're hiding assets, or you're just saying, well, I have an RSP, but I'm not going to show her that or him that document because she's not entitled to any of that. I don't want to give any of that away. So you're actually hiding that from the other person. Yeah,
I mean, we get the question sometimes as well, you know, I don't mind paying child support, but there's no way I'm paying spousal support. And my answer is always the same. It's not really up to you.
That's right.
You know, it's not up to you. The courts have, the legislation says this is how it works, and this is how it works.
That's right.
You might not be happy about it, and I can understand the reasons why you might not be happy about it, but it needs to be done.
Yeah.
So if it needs to be done, your best thing to do is be forthcoming with it, do it as quickly as possible, get the information, because at the end of the day, the separation agreement needs to be signed, and that will help you move on with your life.
That's right.
And so if you don't get this done, this can linger. I've seen cases that are been lingering for years and years and years, and it destroys people.
Yeah.
So it's better to just get it done so you can settle and move on with your life.
Yeah. Yeah, I often tell clients, you know what, I know it's going to save you a little bit of money if you cut corners here and there, but ultimately get it done right the first time, and then you don't have problems in the future.
That's right.
Just spend that extra little bit of money. It doesn't have to be tens of thousands of dollars. Just spend that extra little bit of money and get it done right the first time. It doesn't come back to haunt you.
I agree. I agree. And it's important too that you know, when you're selecting whoever you're going to select, make calls. Find someone that you can work with, or whatever, you know, you need to do to satisfy it. And if you do with a joint retainer, same thing with your spouse.
Right.
But do it. Like, don't think that if you just let it sit long enough, it's going to go away. Make those 5 phone calls, and they might be very uncomfortable phone calls to make. But you got to do it. You got to start the process so you can end the process and move on.
That's right. That's right. Yeah. Well, thank you so much, Matthew, for joining me today.
Pleasure.
We had a great conversation and got lots of great information for clients or anybody that's out there that are wondering about business and pension valuations and income and all of that other fun stuff that goes along with it. So thank you so much. It's been a great privilege to have you.
My pleasure.
Today.
Thanks for having me.
Thank you.